Great to have you here. For those who don't know me, my name is Benny. I'm from the Playground team. And for those who are not familiar with Playground, we are an all-in-one childcare management software. Just to give you an easy look, this kind of says it all. We are an app website to manage everything from your staffing, parent communication, billing, and even preparing for taxes with all your financial statements. That's my 10-second spiel about Playground. And I'm very happy to have you all here. We have plenty of people continuing to join. So without further ado, Gary, I'm going to hand it off to you. Gary is our expert tax knowledgeable person who's joining us today to talk to you guys about taxes.
Excellent. It's a pleasure to be here. And thanks, Benny, for having me here. This is, I guess both good and bad that I love talking about this topic. It's one of my favorite topics to talk about because I think it is such an important one. And one of the things we see when we see taxes in our work across the country, we see an opportunity for childcare business owners to really retain some of their hard-earned income. So we see this as being a compensation opportunity for you and one that you deserve. So let's talk a little bit, first of all, about who I am and why I'm here, right? I'm the CEO of Civitas Strategies. We're a 15-year-old company. We work around the country with childcare businesses, and we help them to improve the resiliency of their businesses. So make those business operations stronger. We do that a number of ways. And one of those ways is through tax education, through helping these business owners better understand their opportunities when it comes to taxes. And the presentation today is based on literally are working with, over 1,000 providers on this topic. I mean, we were talking about it earlier today. I've probably seen more provider tax returns than anyone in the country, especially over the past couple of years with some of the larger statewide projects we've had. So in particular, we're going to talk a little bit about why you should care about taxes. And I know not everyone gets as excited about taxes as I do, but I do. We're going to talk about what a Schedule C is. I know not all of you are sole proprietors. We'll talk about the relevance of this. It's just a good way for us to kind of start down that path, ways that you could be preparing for tax season and ways that you can mitigate taxes. Even now, as we're in 2024, we're talking about 2023 still. So there was a study that was done of some of our work with childcare businesses a couple of years ago. And what that study found was that 83% of childcare businesses operating out of their homes, so this is for your home-based providers, did not claim the business used your home at all. Probably the number one deduction that you can have, people weren't doing it. Overall, we had businesses, both centers and family care, who didn't claim any expenses on their tax returns at all. So no expenses, just revenue. And in fact, it's funny because this is something that literally just came up in our work in New Mexico today, where we were talking with one of our partners and they were mentioning that they had a very similar case. Many businesses were claiming certain expenses, and we'll talk about some of those, which could drastically increase their chance of a audit, which is what none of us want, right? We want to save you tax money. We want to do it within the limits of like what's legal and what's not going to get you in trouble or cause you a bunch of red flags, right? And what we also found was that a number of the deductions were miscategorized or improperly calculated. And again, that can raise your chances of what they call a letter audit, which is when the IRS robots like basically go through your tax returns in mass and they say, well, these things don't add up. So we're going to send Lisa an email and it's going to be either, we're saying you owe us XYZ. And, if you don't like it, then you're going to have to go through all of these efforts to get it straightened out. So, there's a real, opportunity there as well. And some of those miscalculations are ones that could also save you money. So That's something also to think about. It's not just about audit mitigation. So what's a Schedule C, right? Schedule C is what is used by sole proprietors and single member LLCs. You'll also hear people say they'll call it sole proprietor LLCs. So this is the most basic tax return, business tax return you have. Um, the reason why we like to talk about it is because most childcare providers that we see are sole proprietors or single member LLCs. We are seeing an increasing number that are S corporations or LLCs as S corporations. Your tax return is going to be very similar to this one as well. So if you can read a Schedule C, then likely you could read an 1120S. So just know it's like a good one to look at. It's going to document both your business profit and loss, right? So we'll go through it, but it's going to talk about your revenue, your expenses, and then how much you made. And there's 5 different parts to the form. We're going to talk about those in a minute. This is all part of your 1040. So it's all part of your personal tax return. That's what's interesting about when you have a sole proprietorship, unlike if you're an S corp or a C corporation, which is very rare, but we are seeing more S corps where you have a separate tax return from your business. Sole proprietorship, single member LLC is all part of your personal taxes. So let's take a look at what this looks like. This section up here, this first section is kind of reddish section. That's your income. So that's going to be the money that came in. What did you make, right? And what we want to have in there is all your sales, whether it was from the food program, whether it was from parent payments, whether it was from subsidy, that all goes in your income. Additionally, you can put in there grant funds that you've had, and we'll talk a little bit more about that in a few minutes, right? But everything goes in there. Your expenses, this green section, that's where you report everything you spent on your business. And we'll talk more about it, but these have got to be ordinary and necessary, is what the IRS says, right? So these have to be things that should be part of your business operations. They're typical, they're ordinary, right? Other businesses like yours are doing them, and they're necessaries and they're required for your business. So, for example, if you're a center, this question came up recently that has, let's say, uniforms for all your staff, and they have the logo on it and everything else. Well, that's, ordinary. Not every childcare provider does it or business does it, but a lot do, right? And it's necessary, right? It's part of the terms that you have with your business. Now, if I want to dress really nicely for my childcare business, that's not ordinary and necessary, right? Like, in other words, that's not necessarily part of your business. So, what you'll often see is people will say, can my, clothes be considered part of this? And unfortunately, they can't. In this last section, this line 31, this is one where it's basically your revenue minus your expenses, and that's going to give us your profit. And that's your profit or your loss. If you spent more than you took in, it's a loss. If you took in more than you spent, it's profit. This is what ultimately gets taxed, what's at the bottom of this line. It can be really kind of interesting because on the one hand, we want to make that number as low as we can for you in many cases, most cases, many cases. Let's go with many. But we don't always necessarily want to do that. The reason is that whatever that level of profit or loss is what is considered your income as a sole proprietor. So for example, if you go to buy a house, they're going to say, show me your Schedule C, what's on line 31? Oh my gosh, you've been running a loss for 3 years. Well, you have no income to really base this mortgage on. And you may say, well, it's because a lot of my costs are in the business, but it's not going to work. So, something to think about when you look at that profit and loss, we're often going to refer to how do we make it as small as we can. Um, but it isn't always the thing that you want to do, depending on what you're headed to and where some of your personal goals are. Oops. So, let's talk a little bit about preparing for tax season. One of the things that, and this hasn't been updated, this should say 2023 edition, it just came out this week. The URL will work. Homegrown is a nonprofit that's supported by private funders. For the 4th year in a row, we've done a free tax workbook for them. So this is absolutely free. The resources, by the way, I'm going to share are free. So there's no cost to you at all. And this will take you through everything we're talking about today, but it's in a workbook format. So you can easily kind of fill in those pieces. So ultimately, your taxes, as we were talking about earlier, it's all about what you made and what you spent, right? What did you take in? What did you spend? And that first section we talked about is about revenue. That's how much money you make, right? And that includes, again, everything. Typically, what you're going to see is 3 different records that you're going to be able to find your revenue from. One, you'll get some 1099 forms, right? So, for example, the food program, many times your state, if you had a grant, will do that, right? So those 1099 forms can be really important for you in terms of knowing what kind of income, where the source of that was. However, we get this question every tax season multiple times. If they don't send you a 1099, you still have to report the income. So we've had that where people have said, oh, the food program didn't send me a 1099. Do I kind of get out of jail free? No, the IRS is very clearly, you're still responsible for reporting it. Your bank records can be another way to do it, right? Very easily, if you're trying to figure out what your revenue was for the year, how many deposits did you make? Where did they come from? And not to mention your own documents, right? Receipts that you may have given parents where you kept a carbon copy, essentially, and other things as well. Certainly, if you're using a CCMS like Playground, that's another way to be getting these records and getting them throughout the year. So it's a little easier. If you have something like QuickBooks or FreshBooks as an accounting system, that's another source. So in this case, and again, we're using that free workbook as a guide, if you want help with these things and you want to just kind of go to your tax preparer or do your taxes yourself, which we're going to talk about a little bit more later, this is a great way to organize it. And as you can see here, like you just kind of fill out the revenue worksheet. What was your 1099 income? What were the totals for parents, etc.? And this can be a great way to just take some of those records and make it a little bit easier to understand. Second part of it, as we talked about, are your expenses. So how much did you spend? And, in each case, you should have a record of this expense. It's important. Receipts are great. And if you have a receipt, that's a traditional way or an invoice. But you can use other things like canceled checks. You could use a credit card statement as long as it is clear what you are purchasing, right? So, a credit card statement that shows that you spent $100 at Target, that likely won't fly because they won't know exactly what you purchased, right? But if you have $150, let's say, from Sal's Auto Repair, that may be easier to defend with the IRS if you've now subsequently lost the receipt. Additionally, another thing I would say is, don't forget that you can have a receipt created. And so what I mean by that is, I found whatever the size of childcare provider, they're almost universally great at garage sales and finding bargains at garage sales. And a lot of times we'll get asked, well, I picked up such and such at a garage sale. Should I ask for a receipt? How do I get one? It's a garage sale. And what I always recommend is you have a pad and paper with you. You can certainly have a person say, like, Benny, buying this, do you mind just writing, what I purchased, when I purchased it, right? So I'll write, purchased a large duck toy or something, purchased it for $5. It was on February 6th, 2024. And that suffices. So just know that you can create them, right? Not manufacture ones that are legal, right? But if you're at a garage sale or something like that, you can certainly have one there. What's most important to remember is you want to show, if at all possible, you've paid the expense, right? Something that shows that you paid it, the amount you paid, the date, and a description of that item or service. So in other words, it's not good enough to just write $5 and the date, right? But what did you buy for $5? And maybe something that certifies that you paid that amount. Again, as we think about how you use this workbook and how you start to think about getting all your expenses together, what we recommend is go month by month, review your credit card bills. And I know some of you may be larger operations where you say, gosh, um, I just have my business credit card, and that flows into my QuickBooks and we're fine. I've had this business for 15 years. I've had other small businesses over the years. And every single year I go through my credit card, not only the business ones line by line, to make sure that I didn't accidentally miscategorize something. It was a personal expense. Invariably, I always find something. But I also go through my personal credit card because invariably I find a few business expenses that I accidentally put on the wrong card. And I had that last year. It was actually a rather large amount. I still don't know why I put it on my personal card. I don't know why I did it, but I got it squared away. So looking through those, even though it could be a little time consuming, can be a great way to make sure that you're getting all those deductions you should get. App-based system payments, so Venmo, it's another one you should be looking at, right? What were those payments that parents may have had to you? Your bank statements, again, using a CCMS like Playground. This is something you can get out of the system. Or if you have an accounting system, some of these may be in there. It all depends on how well you're keeping up with it. And in this case, again, if you're doing this yourself, if you're bringing it to your tax preparer, you can fill these sheets out in the workbook that I mentioned is absolutely free, and this will help you organize it. This matches the categories the IRS uses exactly, but explains to you what they are. So it can be a great way to just kind of organize it. So I warned at the beginning that there were a few kind of trickier topics, right? And we want to make sure that we talked about those because these are ones that people sometimes get wrong or sometimes overlook, right? And in particular, I want to talk to you about the business use of your vehicle, food, your home, and stimulus funding. So first and foremost, vehicle, right? It's got to be in your regular course of business. So in other words, it has to relate in some way to your business. Now, you know, in this at the bottom, we have a quote that's actually from the guidance from the IRS, regular course of their business. Some typical expenses related to taking children to and from school. This is actually from the audit guide that the IRS has. It's good reading. There is one just for childcare. Field trips, medical facilities, and trips to buy business-related supplies. So this is important to remember because, yes, it has to be a business trip, right? But it doesn't have to be child related. It can be. Could be you go on a field trip and you pile the kids in your car or a couple of the cars, and that counts. It could be that it is you're going to Costco and you're filling up with snacks, right? And that is business related. The rule of thumb for it is that, is that you want to have it, we'll talk more about this in a slide, the one I just accidentally hit, is that you have the majority of the trip be business related for it to count. And you do want to separate it. And by the way, you want to separate it if there's any personal use. So if you have a van that is, used at your childcare, never leaves the childcare facility. Maybe you go out to lunch once in a while, right? And you take it with you. That would be considered what they call de minimis use. So minimal use under tax law. So it wouldn't be a big issue. But if it is your personal vehicle at times, or if you're using it and it is not like, it's coming home with you, right? Chances are that's a mixed use vehicle. And even if it's in the business's name, you have to track both those miles. So again, you want to separate these things out. That rule being that the primary purpose of the trip is business, it counts. This can be a little tricky because sometimes people get confused with it. So, if you go to Costco, you have a long list of supplies for your childcare center. While you're there, you pick up a jar of pickles for yourself. And this is why I'm no longer allowed to have a Costco card, which got taken away from me because I was that person who bought that jar of pickles. But, in this case, right, the primary reason you were there was your childcare center, right? So in this case, the trip would be deductible. Again, you want to separate those receipts or in some way mark the personal expense so it's not going onto your business expenses. But the trip itself would be deductible. Example 2, you're at the supermarket, you're getting groceries for the week. You also say, gosh, I need a box of wipes. And so you throw them in to your cart, you check out. Primarily, you were there for your own groceries. The wipes were incidental. That trip would not be deductible. So just something to think about as you go through that, right? Now, how can you deduct these costs? There's 2 ways to deduct your auto expenses. And you'll hear a lot of chatter among providers about which is best. It's very personal circumstances. And one is the actual expense method. So how do you do it, right? One is you want to keep track of both. We have a question. And I did see the earlier question on the BOI. I will answer that. What if we're buying home and childcare food in the same trip, 1 trip per week taken? Caroline, I would go with what the majority is, right? And I get this question every year. It's a great question. And what I usually say is look at the receipt. If you can show the IRS that the majority of the items, the majority of the cost was for the childcare business, that would be deductible. If it's around the same, that would be a problem. I don't separate food costs. In that case, again, at least half for the kids. I would try to find some way to document that if at all possible. Because if you're audited, when in doubt, they're going to say, was it really a business trip? So if you can document in some way that you're using them, half for the kids, I believe you, but I'm just saying there would have to be kids eat more than my husband and I. I mean, like that's a great example, right? Especially if you're buying things that might be more kids oriented. Absolutely fine to think about. Kabir, did you have a question? Oh, okay, your hand is up. Oh,
Yeah, I
you're
did
coming
have
up.
a
Yeah,
question.
yeah,
So some of the receipts that my wife and I have kept that are daycare related purchases, some of the receipts are not very detailed. Like literally, it'll just be the cost. Like TJ Maxx is a great example where it'll just literally put upholstery item or like bedding item or whatever, and it doesn't specify exactly what the thing is. So if you were to get like audited, how do you like prove, okay, that thing was like a bed sheet or something that one of the kids used or whatever, you know? So like if the description
yeah.
from the actual store or restaurant is not very descriptive, how do you avoid kind of getting audited for something like that?
That's an awesome question. And oddly, I haven't gotten that question before ever, all the times I've done it. And it's a great question. Write it on the back when you make the purchase. It's that simple. So you should just write on the back bedding, right? For the kids or any sort of note that helps clarify it, the IRS will accept that. And I know that could be done after, like way after the fact. Let's not talk about that, but you really are supposed to do it when you make the purchase. And I apologize. I'm so used to like, I always get excited about the questions. I start answering them, but Benny did say that we'd try to answer them at the end. So I'll try to get through as soon as we can because these are
We
some
will
great
have
questions. But
time
again,
towards the end, like
yeah,
you said, for
sorry.
Q&A. So let's just everyone make sure you have your questions in your head. You can send them to the chat, and we'll come to them at the end. That way, we can make sure Gary gets through all his content. Thank you, Gary.
Absolutely. So as I mentioned, actual expenses is the first way. What you're going to see with both of these is you really should keep track of any personal usage. Not should, you have to, right? Advantage actual expenses, this is going to get every cost you have, from gas and tires to lease payments, depreciation. That can all come off. The cons is that typically it's greater scrutiny, and I'm going to say something that like it is what it is, right? Now I may not agree with it, you may not agree with it, but the smaller your business, the greater scrutiny you have using actual expenses. I'm just being honest because the IRS wants to make sure that if it's just you, right, that it's justified. There's also a bigger recording burden, right? So, Kabir, just using you as an example, maybe you're getting all of the all those receipts throughout the year that you have to keep track of with your vehicle, and that may be something where you say, gosh, this is just a pain, this is too much. But you'd have to do it with actual expense. The other option is mileage, and you keep track of the miles, the business miles. You also have to still keep track of your personal miles. You have to do both, because at the end of the year you have to report like total mileage versus business purposes. You could use a simple log or app. I know we said we weren't going to answer questions, Celia and Deb. There was a link earlier. We'll make sure you get it to that workbook. But the workbook actually has a simple log that you can print out and throw in your glove compartment if you want. There's also a lot of apps that are just great at this, like Everlance, Mile IQ. You can get them on the App Store, Android or iPhone. They'll track it. That's what I use personally. Advantage, much easier to use. Cons, the mileage rate is less, in some cases, even though you do get a mileage rate. Some people feel like it's not as much as they get when they do actual expenses. Tricky topic, food, right? Food is fully deductible with two exceptions, right? Somebody, I'm trying not to do it. I won't do it anymore, Benny, because I keep trying to answer them. So food is fully deductible with two exceptions, right? You can, the biggest question that you have with food is how are you going to deduct it, right? In terms of the children in your care, you can report it multiple ways. Staff food, and this is like, I want to put a little caveat on this. So what I'm saying here with staff is, if you buy your staff dinner or lunch or something, it's 50% deductible. If it's your own kids, they are not deductible, right? So if you care for your own children as well as other people's kids, your kids are not deductible. So again, we see two different methods. So if you're a center, you have to use this method. If you're a family care provider, you have an option. So, the actual expense method is the one that you kind of default to. Again, similar to what we saw with, the auto expenses, you have to keep track of everything, right? So Caroline, when you go, you'd have to really, if you're using the actual expense method, you have to make sure you mark off which ones are for the center, right? Like put checks next to them or something. Pros, it's going to include all your costs. If you're a center, you really don't have a choice. Cons, again, if they're really, really high costs of food, it might draw scrutiny. And there's a recording burden, right? You're having to keep all these receipts somewhere with you around. The other option is a standard rate, and this is open to family care only. So centers, I'm sorry, I wish it was different, but it isn't. So in this case, you can keep track of the types of meals, snacks, breakfast, lunch, dinner, and you multiply it by a set number. And that number is the Child and Adult Care Food Program Tier 1 rates. So keep in mind, you don't have to participate in the food program to use the standard rate. This is a record-keeping option. It's not saying that you have to be in the program. It does make it easier You can still, um, keep track of all of these things much easier. You still have to have some burden, right, towards record keeping. You just can't say, oh, I think it was about 50 dinners, so that's what I'm going to do, right? You can still also deduct non-reimbursed meals and snacks. So if, let's say, you have like a hobbit and you're feeding them 4 or 5 times a day, you can still get those other meals that don't fit into breakfast, lunch, or dinner. You can still deduct those. So know that there is that option as well. The cons, you still need to keep the name of each eligible child, in your care, the dates and hours of attendance, number and types of meals served. Which again, if you're using something like Playground, you have a CCMS, a little bit easier, but you can also do this in paper records. There's a variety of other ways. Next tricky topic, and I know somebody, see, I keep getting drawn to the questions because I always want to answer them. I know we're answering them at the end. Your home. So if you are a center, by the way, you can use your home if you justify it, right? So in the case of your home as a center, you would want to make sure that you have an exclusive area. So as we talked about exclusive use, that would only apply to you. You can't use regular use as a center on your home, but you'd also want to make sure there isn't a office that you could be using, right? So in other words, if you have an office at your center and you have an office at home, you can't claim both. The IRS would say you already have an office. You may not want to have to go all the way downtown or something to use the office in your center, but you already have that and it's being deducted as an expense. So know that. The trickier one is if you're a home-based provider, because unlike any other business in the United States, if you're a home-based provider, there are special rules. You get to have exclusive use, which we just talked about. Centers will have exclusive use if they have a home office, but you're also going to have regular use space. So what does that mean? Exclusive use must be used 100% of the time, right? So in other words, it is almost entirely used for your childcare business. We're going to talk about some examples, right? And the IRS can inspect your home. So just know that happens. And in fact, we had a provider last tax season who was audited. They inspected her home. She actually came to us. If you know Tom Copeland, he bequeathed his site to us, so we continue to operate his site and answer the questions that come in free of charge to his site. And this person had emailed us because she had said, I want to be able to show the IRS that they're wrong. And the IRS was right, and in this case, we had to say, no, it's not exclusive use. And in that case, it's not 100% deductible. So they can look at your home. And I got the question real quick, which I will answer, is why did this person get audited? The amount of space that they were claiming for time space for both, we'll talk about the space part of it, but the use of the home and the time they were using it was so high, the IRS said, well, that seems really weird. That's what triggered it. Regular use means a regular ongoing basis. It could even be 1 or 2 days a week, and we're going to have some examples, right? This you use time space for, and we're going to talk more about time space. Let's talk about some examples first of exclusive and regular use. These all came from real cases. These are not, I'm not that smart. I didn't come up with these like pulling them out of the air, right? If you have a basement, we had a basement as a provider in Texas, had a separate entrance only families used for childcare. Now, her big question for me was, she said, look, I had a party a few weeks ago. Some of the family members ended up down there. They were hanging out. Is that a problem? De minimis again. Chances are, if you're not using it on a regular basis, the IRS is not going to care. They're going to say it's minimal use, but 99.9% of the time, it should be exclusive use if you're going to claim it. Another example we see all the time is a storage area. So keep in mind, and by the way, this goes for you if you're centers as well. If you have an area of your home that's, let's say, storing your files, like all your taxes, right? And you're like, let's say you use a third of your garage. This is a real example. We had a provider use a third of her garage. She kept all her supplies there. It's a center owner. that's exclusive use. You have to be able to delineate it, right? Like, so what you don't want to do is say, my basement has the Christmas stuff. It has some stuff from the center. Let's just call it all like 50%, right? Like it needs to be an area that you could theoretically fence off for the IRS if you had to, but you can do that. Regular use, again, gets a little trickier because it means it has to be used on a regular ongoing basis. So again, these are two real examples. So one was that it was a home-based provider and she had, her two children had bedrooms and they typically were not used for care. However, she started to have a couple of kids who were, and a lot of us can relate to this if you have kids, kind of finicky sleepers. So, and they weren't full time. They were there like 1 or 2 days a week each. So those days that those kids were there, she put them in her children's room to nap only. It was only time that any kid was allowed in her kids' rooms just for napping. Well, that's regular use. The IRS would say, yeah, you're using it on an ongoing basis. It's regular use. That's okay, right? Another one we had was we had a home-based provider who only used the family living room to do STEM every week. Never understood why. Not a problem. It's fine. But she just used the living room only once a week for STEM. It counts. Wednesday is STEM day. That would be a regular use. That gets included. So what we do is, with the exclusive area costs, right? Some of those things become a lot easier because for deductions, typically an exclusive area cost is going to be fully deductible. So if you replace a bunch of windows in your home, any of the ones for an exclusive use room would be 100% deductible. You can also have fully deductible costs related to your childcare business. So for example, again, exclusive use, you have that basement. It's the same example of the woman who had the separate entrance because I talked to her about it. I was like, how do you know it's exclusive use? She said, Gary, I have a separate entrance that comes from the backyard into the basement. Nobody else uses it. Where parents pick up and drop off. Great. She was replacing the tile with some new wood planking. And in that case, that'd be 100% deductible. Good to go. Even if it's not exclusive use, putting in something like a child-sized toilet can be. The caveat here, and this is the little asterisk, is if you have small children in the house, the IRS will say, is that really exclusive use? But if, let's say, you're like me, there's no way either of my two sons are going to fit on a child-sized toilet. Anytime, again, I could likely say to the IRS, that's 100%. It's just for the little kids. Liability insurance, again, if it's directly about the liability to your business, that would be fully deductible. Partially deductible, regular use area costs, right? So again, as I mentioned, replacing windows, that exclusive use window, 100%. The common area, like let's say that living room that you're using for STEM, that would use your time space. Repairing your driveway, time space. Home insurance, right, for your whole house, time space. And so what do we mean by time space? I know many of you are familiar with it. We always love to go through it anyway. One, you determine the square footage of the regular use of your house, right? You divide this by the total square footage, determine the amount of time that your home was used for childcare, divide it by 8760, the total hours in a year, multiply those two together. That's your time space. So in other words, it's affecting the time that you're using it and the space that you're using. So for example, business has a home that's 1,500 square feet, 500 are exclusively used for childcare, another 700 that are regularly used, right? If you notice, it doesn't equal the 1,500. I know sometimes people, like their space, right? Like very often the primary bedroom is entirely off limits. You can't deduct that at all, right? She's open 10 hours a day. She spends 1 hour before and after for prep and cleanup. That's important to know. You can include things like preparation, cleanup, this Zoom call if you're a home-based provider, part of your time space. You're attending training, perfectly fine. She's closed 2 weeks a year for vacation, right? So she can't charge those hours. Whoa. Just totally messed it up. Sorry. So in this case, 700 feet, we see this number, we do the hours, right? We're dividing that, comes out to be 16%, right? When we add in the exclusive use space, she gets 49.3% as her time space. And again, that guide I mentioned can go into this in more detail for you.
And Gary, let me also just mention for the
Yeah.
providers using Playground, we have a time space calculator built into our product. So you're able to calculate that very easily within our expense tracking dashboard. And you'd also mentioned in the past the expenses, the keeping track of receipts. Again, for those using Playground, you can keep track of all your receipts directly in the app, upload them to have them as a database source of truth for your taxes in the future. I just wanted to drop that little note in because I know there are some Playground users here.
Absolutely. That's awesome. So, another tricky topic is stimulus funding. The rule of thumb, in other words, because we get asked all about like, what about in Iowa? What about in Florida? The rule of thumb is that you report the revenue, but you can deduct the expenses, right? So the grant, you do have to report as income, whether you get that 1099 or not. But anything you spent it on that was a valid business expense could be spent as well, right? So for example, this can play out in some different ways. So let's say you got 10,000, you didn't spend any of it in the same year. That 10,000 is deductible. Is going to be taxable, right? So just so you know, that is something that happens, especially like we saw a number of the grants, even this past year, would come out right at the end of the year. And if you got it, you'd say, oh, but I didn't have time to spend it yet. Unfortunately, it does count as revenue for that tax year. Sometimes, the revenue is more than the expenses. So you took in $10,000, you spent 5,000. In this case, half of that, right? 5,000 is going to be taxable. However, if the taxable income was the same, and there's a typo here, my apologies, is the same, and like you took in 10,000, you spent 10,000, that's a wash. It's zero. So just know that if you do have any sort of stimulus funding and you didn't have an expense against it, it is something that you're going to want to be cognizant of because that would be taxable. And let's talk a little bit about how we can mitigate some things. Unfortunately, as we come towards the end of the year, or actually as we're at the start of the tax year, excuse me, there's fewer things we can do. What we do recommend, and you can do this for 2024, do a mid-year review of some kind, look at what you're spending, right? Look at your previous year's taxes, look at your revenue, expenses, how much estimated taxes you've put in, right? Unfortunately, we're hitting the point where, again, there's fewer things you could do, but definitely as you come into 2024, this is a great exercise. Look at your revenue, your expenses, see what your profit is. We generally recommend about 20% of your profit you should be sending to the federal government in estimated taxes. If you're a state with a income tax, I'd put another 5% aside, depending on your circumstances, up to another 5% to the state. So think about these things, right, as you're starting to do it, and ways that you then may want to mitigate your taxes. And some of those things are contributing to a retirement plan. You can still do that, right? Maximize that home business deduction if you're a family care center. Again, dig out those receipts. Go through your credit card, right? Go through your bank accounts. Is there anything that you're missing that would be a valid expense? And by the way, I do this myself. Again, we've for 15 years, we've been a virtual business. And so I do this every year. I go through every household expense we had to see, is any of this related at all to the business? Again, that's going through that credit card could find you some other deductions. It's not going to necessarily decrease your tax load, at all, but it's often a good time when you're looking at your taxes to think about paying down some debt or creating a cash reserve. If you see that you do have some money that's left over, often a good time to think about investing in business expansion. That could be something that you could be thinking of that, yes, it may not change 2023, but you may say, gosh, I had some money, it's going to be taxed, but what's left over, I'm going to want to put into 2024. When you're still in the tax year, you can defer income, in other words, like pay me next month. You also may want to think about charitable contributions, right? If your revenue is, when you do this kind of check-in for yourself on where you are, where you've been for the last tax year, if your revenue is low or negative, think about ways to reduce those expenses. Think about ways to improve billing and collection process. And this is something, again, CCMS like Playground can be very helpful with. Explore financing options if you need them, right? Sometimes, unfortunately, debt is needed to continue the business. Evaluate your pricing. And this is like a national epidemic. I think every year, at least every year, every child care provider should be thinking about their pricing. And if you need to, seek professional guidance if you're really desperate. So, and I know we have a ton of questions, so I'm trying to jet through some of the content so we can get to the questions in the time we have. Getting your taxes prepared, you can do a paid preparer. They guide you along the way. It can be expensive. They may provide you with advice. Honestly, I think few do anymore. It's more about preparation and getting it done. Self-preparation, usually getting guidance from a human being costs you extra. Like if you do TurboTax, it is less expensive. It does also tend to be more accurate. If you are going to seek a paid preparer, ask if they're qualified. Did they receive training? That guide I mentioned has some more extensive questions. Have they worked with childcare businesses? Do they understand your business? Absolutely critical, especially if you're a family care provider because of those unique rules that we talked about around your business. Are they available after tax season for advice or changes? So many times we find something with a provider that needs to be changed and they go back to their tax preparer and they're like basically closed till next tax season. Can you get a copy of your return? Legally, they have to provide you with one. Very often they will say, no, we won't, or it'll be for a fee. Not acceptable. Keep walking, find somebody else. Self-preparation, again, probably looked individually at more provider tax returns than anyone in the country. I've dealt with a ton of preparers. I'd give Tom Copeland the win on that. He's dealt with more of them than I have over the years. My conclusion is self-preparation is a great way to go. If you can tolerate, using tax software, I know a lot of people get fearful of it. It can be great. It can be more accurate. You're less likely to be audited. The federal government says that because they do believe that the tax software is better. If you do want to go this route, this link down here, there's a guide for TurboTax. There's also other guides that we've produced for Tax Cut, and H&R Block. These are free of charge. These were done through the goodwill of the Wisconsin Early Childhood Association. So you'll see their name, but if you're in New Jersey or Iowa, don't same federal laws, right? These guides will take you step by step through how to use TurboTax and other software programs, including having screenshots on how you can prepare it yourself. So that business portion that often makes people afraid, that is something we cover there. Don't hesitate to follow us on YouTube. As I mentioned, we also run Tom Copeland's site. So there's some resources there as well. So
awesome. Yeah, we have plenty of Q&A questions, Gary. First off, just want to thank you for all that wonderful content. For those who have asked, this will be recorded and we will send this out to everyone that has asked questions or anyone that RSVP'd. Gary, not sure if you have any questions you want to start with.
No, let me go into them while I can, right? Because I know we don't have that long. People will have to return to their classrooms or, kids will wake up or something or stop eating. Somebody asked about the beneficial ownership information. This is a new requirement this year. It is, excuse me, I rarely act this way, but it's ticking me off. So it is not hard to do. I did one of our companies myself. I timed it 11 minutes and that included me screwing up twice. Not because it was hard, because I was dumb. I was like, I'm smarter than this. I'll do it quickly. It is a requirement from the federal government, is super easy. We are seeing tons of tax preparers on the sites I'm in. They're charging anywhere from $600 to $1,200 plus to do them. Not worth it. We just did a video that was free. The recording, I believe, just came out today. If you go on our site, Benny, we can talk to you, because that was one also that Playground helped bring us to everyone for free. That's another one that we can send out, that recording. We also have it in multiple languages. So take a look at that recording. That'll give you that information. What if we are buying a home and childcare food in the same trip? We did talk about that one. Again, you can also mark them as well. How do you get the workbook? I know somebody else reposted that later. Yes, somebody had said, keep in mind that when you use the standard mileage rate, you can still deduct parking and fees and tolls accumulated when driving for business purposes. That is correct. I don't see loan interest mentioned. It is not, unless it is business loan, it would not be. Please provide a link to the childcare audit document you mentioned. We can do that. Can I deduct a parent that does not pay her copay because she cannot afford it, like a scholarship? No. So if she doesn't pay it, you can't deduct it. And I know that gets confusing. This is something that comes up with parent discounts, parent copays. It also comes up with cases where you're paying for care for your employees. If you're foregoing the revenue, you can't deduct it. You can deduct the costs, right? Like, so you're allowed still, Julie, to deduct the costs associated with caring for that child, but you can't deduct the lost revenue. Should I keep personal receipts? As long as you're not deducting them on your taxes, I wouldn't worry about it. Either for your personal or otherwise. Jan, thank you for putting up the homegrown tax guide. Appreciate that. If I only use the standard meal and snack rates, do I have to serve meals within a range of times? You do. Those times are set by the federal government. You do see them. They do have to be within those times. And basically, it is like one meal between those times, and you'll see how they're divided up. I don't remember the distances between the times yet, or offhand, but you do have to serve it within those time frames. So you either get actual expense method or mileage. That's absolutely 100%. You get one or the other. You don't get to do both. And you can't just pick and choose which expenses. So if you had a big car accident or something in repair, you may want to think, is that worth doing the actual expenses versus mileage that year? Is there an official federal government website, standard meal and snack rates? There is, and we can also share that with you. Tend to actual expense of food and standard rate to see which one is better at the end. Kenya, that's a great idea. I do recommend with some of these things that you may want to. Auto's another one, especially if you've gotten a new auto in the past couple of years. The depreciation may make it worth it to do actual expenses. May we list an expense, the $360 we pay to fix up our backyard sprinklers? Yes, they play in the sprinklers, etc. It would still be considered shared, both personal and business, even though I get that it's probably primarily being used by those kiddos. The IRS would see it differently. In that case, you would apply time space, which I know is weird because your backyard isn't included in time space, but it becomes the way you calculate how much your home is being used writ large for the business. Purchase a trampoline and net for the children. Do we include time space in assembling them? Time portion or time space calculation? You actually can, include that. And same thing goes. We had a family care provider last year who her spouse did a sandbox. I don't know why I can't think of that word, etc. She can use those hours. Utility bills received in January were usage part of December, part in January. You apply time space. What I would do is, this gets a little complicated, I would prorate it. So if it covered 30 days, divide the bill by 30, multiply it by the number of days that were left in December, and then multiply that by your time space. Did that make sense? So in other words, come up with a simple way to figure out how much was in December, multiply that by time space, because the January portion is going to go on your 2024 taxes. If food was purchased from a restaurant for staff, could you deduct 100%? It depends on the situation. Basically, what you'd be looking for is that it was some sort of company event that was open to every employee, not just certain employees, that it was accessible to everybody, and that it was company related and considered company time. Think about those elements. I paid my full homeowner's insurance premium covering 8 months in 2024. Again, what you want to do is, in that case, if it's 8 months, divide it by 8. September, October, November, December, half of it is going to be applicable to 2023. Multiply that by your time space. Adriana was kind enough to put the reimbursement rates in. Thank you. So that one's handled. Intentional scrutiny of value and justify the expense. You should claim the expense. Absolutely agree with you, Mary. You know, what I always tell people is, if you can defend it, if it's something that is real, that is legal, you should take it. You shouldn't, don't try to panic or run away. When I say, worry about an audit, I'm more worried about when people get too bold, when they start saying, I know this really isn't valid, but I really want it to be a deduction. That's when we get into problems. But if it is, something you can be backed up, that's, perfectly fine. I bought a dishwasher. May I apply time space the entire amount? On form 8829, other expenses. I feel like I should know this, in terms of, so apply time space in the form and then apply the total amount you would. I'm just trying to remember if it's other expenses or if it technically goes under equipment. That'll be in the guide. Years before starting my chat, installed a newer roof due to hail damage. Homeowners insurance reimbursed cost except the deductible. Term of depreciation. Do I apply time space the entire cost of the new roof or just the amount of the deductible? Email that one to me, Rick, because I want to just make sure on it, because that is an unusual one, and I want to take a look at it. Don't like shooting from the hip. Is there a specific percentage of time space? You do have to use that calculation. Definitely want to use it. Had an advisor say to me, we should not worry about time space percentage. Most small businesses will just use the standard deduction. Like I said, I've looked at more of these than anyone else. I have not found a case where the standard deduction made sense for a home-based provider, full stop. For some small businesses, the standard deduction may make sense. If you're a center and you have like a small portion of a room that's being used exclusively as your home office, maybe, but I would be really, I don't see it personally. But I do see tax advisors pushing you for it because it's easier on their end. It's a lazy thing. Can I claim the basement if the office, my basement is there? Yes. But Harold and Paula, I would just be careful on, are you really using the whole basement for it? Maybe you have a smaller basement and you can say, yeah, I do use it. There's a couch over here. I meet with families, prospective families, and we talk or something. Maybe you can justify the whole basement. But if it's a real big basement, you're really only using a third of it, I would say don't get too bold. That's a place where you might get too bold and get into a little bit of trouble. So I have basement. I use entirely 100% for my daycare, 2 babies of my own. I watch them with other children. Is my daycare still 100%? Yes, because you're using that for your operation. Now, outside of your daycare hours, if your kids are still using it on a regular basis, that's regular use. Replacing the flooring in the front room, dining room, kitchen, bathroom, used for both daycare and family. Can that be time space? That's right. Good work, Melissa. How would we apply a new roof on a home? Typically what you're doing, and this is in that guide, you'll see some information on it. What you're going to do is you're going to do time space, and then usually with a roof, the cost is going to be enough where you're going to have to do depreciation. So you're going to have to take that over a couple of years. A friend of mine does her own taxes. Program she uses a standard deduction for a small business. She finds this better than keeping track of her deductions. What is this deduction? How much is it? There is no standard business deduction. So I'm not really sure what your friend is doing. I'm sorry to say. Karen, don't hesitate to email me more information if you have it, but it's not like your personal taxes where there's a standard deduction. I've heard this before, by the way. This is like a prevailing myth. I've never seen what the number is that people are putting in. I've never actually seen a return with it, but I've heard people say, I know this person and they're doing a standard deduction. Driveway repair, including time space. It's not, you're right. It's not included in the square footage of the home, but you still use time space for it. What do you do if you have your own babies when figuring out time space? In terms of your babies, the question is, what spaces are they using during outside of business hours, right? I know we're a little over time. Is it okay if I keep going, Benny?
Yeah, feel free to, I mean,
Okay.
as long
All
as
right.
you would want to be here, we're happy to have you.
Okay, I can go for a few more minutes. How much is membership from Playground to get access to the tracker? Benny, I'll let you take care of that one.
Yeah, and we'll talk about that after you're done with all the Q&A.
Do you do time space rate for your home insurance and full deductible on childcare required insurance? So if it is entirely for your business, that would be 100% deductible. If it's your homeowner's insurance, for example, no. So your liability insurance for the business, 100%. Homeowners for time space. Concerning time space, do I still use a full year if I start in July? Melissa, that's an awesome question. No. Just as Derek is saying, you would use the portion of the year from when you started. Good work, both of you. Great question, great answer, Derek. Appreciate it. Will we get this recording? Benny answered that. Our childhood council accepts the grant funds and purchase items for providers. Providers only receive the item needed for childcare. Do providers need to record any of that on their taxes, or it's only recorded on the council taxes? Technically, Michelle, that would be provided to you in kind. So yes, it would be, you'd be reporting the value of it. I would think about, depending on what you're trying to purchase there, some of it might be de minimis, like if they're giving you, like back when like masks were being given out and you got like a $50 box of masks or something, I wouldn't worry too much about it. But if they're providing something valuable, like thousands of dollars, unfortunately, that doesn't get around the value that's been transferred to your business. And that may be something, and I'm happy to talk to them, that the childhood council isn't aware of. A lot of times they'll think that they're doing you a favor and they're really not. Can you discuss giving employees a 1099, don't have a payroll service, and fewer employees to help me out during the year? Other free resources. One of the states we work in is Texas. If you go to childcare.texas.org, yeah, you will find on there a number of resources, free resources. There's one entirely on how you fill out the 1099. Any word on bonus depreciation, Bill? If you go on our Facebook, we just sent out or posted a video from our government relations person who's been calling his contacts in DC. The answer is, I would call your senator, but it may be worth watching it. It's only a couple of minutes. Matt did a great job on it. How about Tax Act for Business? I've actually used that personally, Melissa. I don't find it as easy as TurboTax for Business. I know it's surprising, but I prepare my own business's taxes because I enjoy it. Can you put those in the chat box? Not sure what those are. Sorry. Mentioned a guidebook. Is that same as a workbook? Yes, it is. Sorry. We'd love to have the recording. We're on that. Benny put the workbook in again. Send me the recording. Receive grant funds and use these funds fully for rent. In any other case, would you use time space to deduct a certain aspect of rent? Since the grant funds are used, can you deduct the full year of funds completely? You're still going to have to use time space. And this has been a big problem, Kabir, is that like we've had a lot of people who've said, well, the state is allowing me to use it 100% of my rent, and I'm a home-based provider. Unfortunately, for taxes, you still have to use that percentage. And my argument would be, looking at the statutes, the state shouldn't be approving that. We're on the food program. We use standard deduction. We just keep receipts on our record miles. Do we need receipts for personal trips? No, but you should be keeping track of your overall miles throughout the year. So you should know where your odometer started and where it finished at the beginning of the year. right? Because business miles minus total miles is going to give you the personal miles, and you do have to have that on there. Phone bill deductions. I'm at home childcare with designated landline just for my business. Too many parents call me on my cell phone. Two separate bills companies. Unfortunately, the cell phone in that case would not be deductible, which I know is frustrating. Please send me the recording. Send me a recording. Link for times of meals. That was earlier. Landscaping considered a deduction. Planting flowers. Yep. Use your time space, as well. IRS audit guide. Awesome. Thank you, Jan, for getting that in there. Heard that as an LLC, I can employ my children. Tessa, again, go to that Texas site I mentioned. There's a free guide on how you legally employ your child. It's a little bit involved, but we want you to follow the letter of the law. There are some ways to do it. Please include chat info when sending a recording. We have home childcare, installed the turf area in the yard. Is that entire project 100% deductible, including our own time? Again, like with the playground equipment, Gina, it gets a little hinky. So if you have children who may be of age to use that playground equipment, time space it. If, let's say, a couple of weeks ago, I had a senior who had done that. Kids are like, her grandkids don't even use it. Good to go, right? Why wouldn't a repair of roof be fully deductible when the new IRS rules subject timeshare percentage? The repair of a roof, why wouldn't it be fully deductible? It wouldn't be deductible. The time space portion of it would have to come off first. And then due to the cost of the repair, it would likely have to be depreciated. I hope that makes sense. I have family daycare. My husband changed the floor of my daycare. Possible to pay him and put that like expenses. Maria, you can, but then he's going to have to report that income as well. Mr. Answer, regarding the standard deduction comment, can you elaborate? There's no standard business deduction. And again, like I said, I've heard this before. It's kind of an urban myth. There isn't anything. Would I have to provide audit proof on when I serve the meals? You should be keeping track of it in some way. Yes, you would have to provide a log. I can do the 1099, no problem. I want to get audited, having an employee when they said they were an NEC. When then are they independent contractor versus employee? So with, again, that site that I mentioned in Texas, we have a guide there too. Also goes over who's an employee versus who's a contractor. Typically, if they're in your home on a regular basis doing work for you at your direction, they're an employee. They should not be a 1099. Then I use my cell phone for daycare for the parents. Can I take a break? You're absolutely right, Erica. Oh, I'm sorry. You wrote that as a direct message, and my apologies if I should have revealed your name. You are correct. Let me go back. She has a dedicated landline, right? That's deductible. Actually, sorry, she isn't correct. The cell phone, the problem is that the IRS is going to say that's personal use. They're kind of weird when it comes to telephone usage because you do have that dedicated line that you'd be using there. Benny did put the childcare.texas.gov site in as well with the free business resources. I think that got us there.
Wow. I want to give you applause on behalf of everyone in the audience.
And let me do one other thing.
Yeah, go ahead.
I'm just that's my email. So if you still have questions, I'm happy to answer them. I know there was one person where I said, email me, you now got it. Email me that question because I do want to look at it, the one where there was damage to the roof, just to make 100% sure, because sometimes, I try to keep a lot up here, but it's pretty broad base when you start talking about tax law.
Awesome. Well, Gary, I want to say thank you for all that knowledge. You, I think, are one of the most skilled people in this area, and everyone, I'm sure, learned a bunch from this session. I'm hoping we can put another one together in the future before we have to finally file taxes, and we will continue to be partnering with Gary, hopefully, for many more, childcare business, tax events, resources, and all these sorts of things. So if you have not already subscribed by joining this webinar, you've subscribed. we will be sharing more events with you in the future. And for those who are using Playground, I just wanted to bring one thing to light with you. And I will share that right now. I just want to show everyone how you can easily pull that time space calculator percentage in Playground. So I'm just going to share my screen quickly. For those who want to drop off, thank you very much for joining. And for those who want to stick around, you can just check this out quite easily. So this is the Playground expense dashboard for those who are not familiar. And I just want to quickly bring your attention the way you get here. You want to make sure in settings you are set to a family childcare center type. So you can either be a center or family childcare. And if you are set as a family childcare, you can then go into your expense dashboard and click on your time space percentage calculator. And we will help you calculate your time space percentage. So you want to know obviously your space information, how many square feet is your home, how many square feet are you using exclusively for childcare, how many hours are you open per week, et cetera, et cetera. And based off of this, we will help you determine your time space calculator. You can then also track all your receipts in Playground, and you can see here easily the receipts, expenses that you have. You can add receipts for any of these as well. And we will then also help you automatically categorize these based off your time space percentage for your final end of year taxes. So for those who are using Playground, check this out. And yeah, again, lots more questions coming through. We will hopefully be able to answer them all now and in the future. Thank you everyone for joining. Very well presented, Gary. I'm getting some comments. Thank you so much. Thank you. A lot of thank yous.
Absolutely glad to help. And like I said, don't hesitate if there are other questions that you have.
Thank you very much, everyone. Thank you, Gary, for joining us.
Take care.